I think this is one of the bigger misconceptions, isn't it? Is that people think that the equipment price is going to have such a massive impact on the economics, whereas what we're consistently seeing, it's the way you consume energy, it's the price you pay for energy, designing the right system, and actually you can navigate some of these equipment price swings and capital costs because they're such long-term investments.
Absolutely. I mean, the really big value driver out of this is actually what the value of each electron that you produce is.
On-site energy systems aren't short-term plays or lowest price win decisions. They're long-term value-creating investments. And when they're assessed, designed, contracted, and developed correctly, the returns can be incredibly powerful. But the flip side, miss a few critical details, and those same projects can underperform for decades. Today, we're joined by Calvin, VECKTA's co-founder and our expert in supply chain, contracts, and procurement. And he's been deep in the data and the delivery of on-site energy projects around the world. And we're breaking down the key factors that truly drive project value, and in particular, the ones that have been dominating the headlines recently: tax credits and foreign entity concern challenges. How do you manage these risks? How do you maximize the opportunities? And what happens when you don't? Let's dig in.
Gareth, Calvin, good to have the crew back together. It's been a while since having you on, Calvin. Super excited to dig into everything today. Before we do, we always like to do a quick check-in. What have you been up to lately?
Well, hopefully I'm not too rusty. It's been a little while since I've been on Renewable Ride, so it's great to be back. Since I was here last, big news in my life is I've relocated the family just temporarily through till just after Christmas. We're based out of Auckland, New Zealand, which is where my wife grew up. I've got a set of grandparents out here. So reconnecting, spending a lot of time with extended family and with my wife's old friends. It's absolutely delightful, amazing city. So I've been very happy with the move to Auckland.
Love it. Gareth, you've had some changes as well. What's going on with you?
Yeah, all good here. Great weekend. Managed to get Ethan exposed to what Scouts is all about this weekend. So he got to BB shoot, do some archery, do some rock climbing. So it was a nice adventurous weekend. Got out for some mountain bike rides myself, and the wildfire season was declared. So that's nice. Kind of leaning into winter and excited for the snow in the mountains and some skiing to begin.
Love that. You know, scouting's near and dear to my heart. So excited that Ethan's digging in there. We had a bit of a birthday weekend in our household. Celebrated the four-year birthday and did it at one of our favorite places, the Ocean Institute. So continuing to support a love for nature and in particular the ocean for my boys, which also included me dressing up in a shark outfit, which was quite entertaining. Well, good that you guys are doing well. Calvin, super excited to have you on and really dig into a topic that continues to be extremely top of mind for really all of our clients, which is around risk mitigation. And particularly it's been very topical of late, just with how dynamic the market has been, the changes to the tax credits and the timings associated with them and the foreign entity of concern compliance. And we've talked about this in other episodes, but I think really what we want to dig into today is when you really start to engage the supply side of the market, how do you ensure that you're capturing all the value and minimizing as much of your risks as possible? So maybe you can start us off with just kind of giving a bit of the lay of the land of some of the unique attributes of these assets, and then what's really been happening over the last couple months related to the tax credit changes, and more importantly, how we're incorporating that into making sure that our clients meet all of these regulations to maximize value.
Yeah, love it. Let's start by talking about what it is that we're contemplating investing in, and a bit of a framework for how to think about that, and then we can sort of go down a few levels into what that unpack some of that. So we're talking about investing in on-site energy systems. These are long-lived pieces of infrastructure. Solar panels will come these days with a 30-year production guarantee. It's a long time in anyone's business. And they're also assets that you spend all the money up front. You're putting 90% of the life cycle cost there or thereabouts into the installation. And then you're getting all of the value on the back end of that for 30 plus years. So you do have to be robust and thoughtful in making sure that you're doing this at the right properties within the portfolio of where you're working, and that you're building the right assets. To think about how we might break that down a little bit, we can think about an investment on really two big buckets. One is that it's going to generate some value. And if we just think about solar for a second, the value that it generates is it's going to create electrons. It's going to turn the sun's energy into electrons. And then you're going to get some value for each electron that gets generated. And then, of course, it costs money to build these things, and it costs money to operate them. So we can think about the life cycle costs of an asset being broadly the capital that you put into constructing it, the cost to keep it operating and maintain it. And then in the US in particular, most of the incentives that come in, there's always incentives on both the value and the cost side of things, but most of the incentives are on the cost side of things, and they help to offset some of the costs. It's a long-term asset, so we also need to talk about timing. So really broadly, think about it as the total value is the value that we generate minus the cost to deploy and operate, to the power of the timing of when those things happen.
And I know, Calvin, you've been looking at a lot of projects, but you've got one project that we can use as a bit of an example as we go through the different scenarios and the opportunities and risks associated with decision making. Do you want to just frame up the project that that uses the base case and then manipulate to show the upside and downsides of making these decisions?
Yeah, for sure. So this is a really simple example. It's going to cost about $1.7 million to build, with a 4-year payback based on 15 cent per kilowatt hour blended cost that this company is paying to the utility for energy. It's a nice pivot to then sort of talk a little bit about how does a project like that actually generate value. We're going to deploy a megawatt of solar on the roof of the facility. Once it's built, the sun's going to hit the solar panels, and those are going to generate electrons. Every electron that gets generated, that's one that you don't have to buy from the utility company at 15 cents per kilowatt hour. And really the value in this is offsetting utility cost on your bill. There are other ways that solar projects generate value too. They can play in wholesale markets. You can sell offtake to the utility if you produce more than what you want to consume. You can subscribe to things like community solar programs, but we'll keep this really simple. So we'll just use that as an example. This baseline project, it's got a net present value of about 1.8 million. So just a little bit more than the total capital cost. That's an NPV including the cost. So it generates about double the value that it costs you. Overall, and an internal rate of return of just around 24%. So we'll use that as some basic numbers, a 4-year payback as well. That is a pretty investable project in the context of most businesses. Most folks would be pretty happy to get a project like that away.
So, Calvin, as we're talking through this, you mentioned large part of the value here is largely avoiding overpaying for the electrons from the utility. Can you talk a little bit about some of the risk mitigation that can happen on the front end to make sure that you're building the right system? Like in the example that you described there, the facility, maybe it could hold 2 megawatts, but you're suggesting 1 megawatt. Talk us through how you figure out what's the right system so you're maximizing your value.
Yeah, perfect. So these assets, when you build them, they are a one-way door kind of asset. Once you spend the money on building your solar system, it's not like you can pack it up and move it to a different building if you don't like it, or if you built a little bit too much, that you might sell some on in a secondary market and reduce your capacity. It doesn't really work that way, you know. This is an asset that once you spend the money on it, you're kind of stuck with it to a degree for the life of it. You can augment it, you can make it bigger, you can do some things to tweak around the edges, but you want to make sure you get it right. This is not like, you know, a logistics company that buys a new big rig and they put it on a particular freight route, and then that route gets less busy and they reallocate the big rig to run somewhere else, or they take it to a dealer and sell it. You can't really do those kinds of things with solar, and battery storage is much the same. So you need to make sure you're investing in the right projects up front. Two levels to that. One is if you're a large business and you operate across a broad range of locations, you want to make sure that you're investing in the right locations first and foremost. You know, those are going to be places where the sun shines a lot, the cost structure of your utility bills is high, and you've got the space to operate and the space to go and deploy things. We do that kind of portfolio analytics every day here at VECKTA. We like to do it from the ground up. So you start with the sites and you build you find what the optimal system is at every site, and then you schedule them out into everything that makes economic sense and makes it over the hurdle. When should we do it? How should we fund it? On an individual site level, then you're trying to balance for every incremental bit larger that you might build solar, you're going to be potentially at some times when the sun's particularly sunny, generating more than what you might need to consume yourself. So can you sell that electricity out to the electricity grid? Generally, yes, but generally you get a little bit lower return relative to offsetting self-consumption and balancing that out against, you know, how your consumption patterns look on a day-to-day, week-to-week basis. There is an optimal answer to what you should build at each site. Again, it's a part of work that we spend a lot of time on here at VECKTA, helping folks to understand what that looks like. There's some relatively complex mathematical optimization that goes into it, and you want to make sure that you're getting the best possible return on the capital that you're putting to work there.
I think what we find, Calvin, is these systems are incredible when they're planned and designed and installed and ultimately maintained well. And a lot of people actually forget about maintenance costs. They forget about the equipment isn't always going to perform as it was originally designed. It's going to degrade over time. If we go the wrong route and procure the wrong system or have mismatched components, these can all lead to sub-economic outcomes. When you think about ranking these risks, where does this fall into a level of concern that people need to be mitigating against?
Yeah, getting the output that you plan for is super, super important. And relative to other assets, you know, even relative to other energy generating assets, these are actually pretty predictable. As long as you have a high quality installation, the amount of solar that a solar panel will generate if you install it, you know, facing this direction on this particular roof, solar modeling software is very accurate in estimating how much solar you'll make or how much electricity you'll make on an annualized basis or even on a month-to-month basis. Minute to minute, it's more variable. You know, the clouds either turn up or don't. So you do get those kinds of ups and downs, but in a blended kind of annual aggregate sense, it's very predictable what you're going to generate. But underperformance is really terminal for a project. So an example we modeled out for that project I just mentioned, the 4-year payback project. If you ended up with a system that didn't perform well, typically solar degrades over time, somewhere between 0.25% and 0.5% a year of production dips each year in a very predictable way as the panels are exposed to the sun and just become less effective. If instead of declining at 0.5% a year. You declined, let's say for the first 5 years at 5%. And you ended up then leveling out. So you might end up at about 75% of your predicted capacity each year. What would happen to your project? You end up losing something like 32% of the NPV of the project by losing that 25% capacity in the generation. So the project still is not a bad project under those circumstances. Your payback pushes out from 4 years to about 4.6, and your internal rate of return drops about 3.5 points. It's still a 20% IRR and a $1.2 million NPV project. Not terrible, but really impactful. And O&M will kind of, as we dive into where's the value and where's the cost in this kind of framework, we'll get to O&M, but to foreshadow that a little bit, it's a very small part of the overall cost structure, but a really important part of the overall value structure. You've got to make sure that you get the output that you promised.
So, and that makes complete sense. And we'll dig into more on the operations and maintenance side here in a bit. But before we do, let's continue to run with that example, Calvin. You said it was roughly a $1.7 million CapEx project. So when I've gotten a couple bids, these are fixed price bids. What can go wrong? Like it's $1.7 million. Like that's all I'm going to pay, and it's going to be built on time. What are some of the variables that might throw a bit of a wrench into that price tag?
Yeah, and I mean, these are construction contracts a lot of the time too, right? So you'd think you should be able to get a fixed price type of engagement, and you'll have an EPC. How is it that you might end up having to spend more? That's a pretty reasonable approach to take, and that's what most people do. They are fixed price contracts. One of the biggest things that's been happening in recent times is tariff changes. Many of the components of solar installations are imported, so tariffs make a difference. And even for those that are domestically produced, they compete in the supply market with imported components. So as soon as the import prices go up, the domestic manufacturers respond by increasing their prices and take a little bit of extra profit too. So tariffs make a really big difference. The other thing about this is many of these projects are installed on existing structures. You know, you built the shopping center or the factory or wherever you're installing the solar on the roof, somewhere between 5 and 50 years ago. So you think you know what you're going to find in the structurals when you start going and doing the installation, but that's not always the case. You might find that some parts of the roof need replacing, or that the structure can't bear the weight that you thought it might, and you need to modify the design or spread the footprint of the system out as you're working through construction. And that ends up resulting in variations. It's normal to have variations, and it's hard if you haven't done a lot of these sorts of projects before, because if you've signed a fixed price contract and then somebody comes back and asks you for more money, always the instinct is to say no. You agreed to do this for this price, and the installer will say, well, look, but things are different now, and I need more money. And there's a little bit of truth on both sides there. It's important to make sure everyone still feels good about the project. If you're thinking about that from a risk perspective, if you're the person investing the money there, you've got to acknowledge that price could be going up for legitimate reasons. If all of a sudden that makes the investment no longer tenable for you, and you want to change your mind, you've got to think about having appropriate off ramps. We do that at VECKTA with the way contracts are structured. So you keep your cost of an installation low up front, make sure you're not overcommitting, de-risk things like structurals and roof conditions. And that's when you start placing bigger orders for things like equipment and hardware and whatnot that drive lots of the cost of the project.
Calvin, we've been in a time over the last 6-9 months where there's been a lot of changes and volatility, and we've helped some clients navigate, the early April think it was called Liberation Day, all the big tariffs that were dropped down. But like, okay, if I'm signing a contract, what are some of the ways that we've advised companies to not be subject to kind of the market whims, if you will, and bear the brunt of that? What are some of the ways that they've navigated those?
Yeah, once you get confident that the design is right and the project's installable and it hits your investment metrics, we encourage people to actually place those equipment deposits and lock in their costs. Once you've done that, you either take possession of the materials yourself, or they're held for you by a distributor, but they're tagged to you. You've paid for them. You lock in your costs. If tariffs change, if the market changes, you're no longer subject to that variation. It's also helped as we get into talking about the investment tax credit and foreign entity of concern compliance. That early spend also helps folks to safe harbor projects under IRS guidelines as well. To give a sense of what happens when capital prices change, the what if is what if capex goes up by, or what if like equipment costs go up by 10%, 20%, something like that. Let's say equipment goes up by 20%, and that overall that hits your capex as a 10% price increase. You're moving your $1.7 million spend up to $1.9-ish million spend. What does it do? It pushes your payback out by about a third of a year. So you're out to about 4.3 years of payback. You lose a couple of points on your internal rate of return, and your NPV drops by about 5%. Why does NPV not drop by quite so much? Some of that's to do with tax. Some of it's to do with, you can claim the ITC on the higher cost that you're paying. So you actually get some of it back in incentives. There's a whole can of worms to open up there, which we'll save for another time, where you get your tax credits. They're measured against the value of the project. So you're going to get 30% of the value back as a tax credit. The 30% is pretty clear. The word value can mean lots of things to lots of different people. The typical default is to use the cost of the project. But if you think about it, the value of the thing has to be, at least in some way, more than the cost of it, or otherwise why would anybody build it? So typically the kind of rule of thumb is that you use the cost of construction as the measure for the value. But there's plenty of folks who work to optimize maximizing the value of those tax credits beyond that too.
It's great seeing the data though, Calvin, because I think this is one of the bigger misconceptions, isn't it? Is that people think that the equipment price is going to have such a massive impact on the economics, whereas what we're consistently seeing, it's the way you consume energy, it's the price you pay for energy, designing the right system, and actually you can navigate some of these equipment price swings and capital costs because they're such long-term investments.
Absolutely. I mean, the really big value driver out of this is actually what the value of each electron that you produce is.
Yeah.
So if I take a step back here before we get to costs, this project that we're talking about here, the value is in offsetting the cost of utility energy consumption. And what we've seen across the US and really around the world is that the price of electricity in most markets is increasing really substantially. We've seen the US increase. I think the number is 22% in the last 4 years is the ongoing underlying cost increase. And it's showing no signs of slowing down. So when you measure the value of each electron that this solar system is going to generate, you've got to think about what is it doing? And it's saving you from spending however many dollars you need to with your utility. Having good understanding of what's happening in utility markets and getting those assumptions right in your cost model up front are what helps you to de-risk that. We spend a lot of time at VECKTA on market intelligence, getting folks really comfortable with what is actually happening in my utility market. What can I expect to happen going forward? What are the alternatives to just paying the bill at the end of the month, each month? And it's fair to say, Gareth, there's lots of folks out there who are really concerned about this. It's worth being worried about. Data centers are hoovering up all of the power that's available, and other businesses, the resi market as well, are being left to pay the difference and soak up the cost.
Yeah, I was speaking to a CFO at the end of last week, and I think energy price escalations has been on people's mind for a while, but I think the concept of risk hedging and having energy cost predictability has not necessarily been as front of mind. But this CFO was saying he projects his energy bill to be approximately 200 grand a month, but they keep blowing through their peak demand charges because business has been good, so they've been producing more product. And then they've been tapping into these peak demand prices, and he's seeing his bills hit 250, 300, 400 grand a month sometimes. And if he'd have had a system that accounted for that and could manage those peak demand prices and lock in those rates, having that cost predictability, I think, is going to become increasingly more important, and having the confidence that the system is going to perform as promised and that you've navigated these commercial outcomes, super important.
Yeah, absolutely. Well, to give you a sense of it, this example project, we used 5% as the ongoing utility rate escalation, which is kind of middle of the road, maybe a little bit more aggressive than you might expect in some places, and a little bit less than you might expect in others. If instead of it being a 5% utility cost escalation, what if it was 10? What if it landed at the range of what people might expect? The NPV there for that project, instead of being around the $1.8 million, it jumps up to like 3.6. And you double the NPV of the project if you double the rate of utility. If you drop it down to like a 2% increase in utility rates, this is still a really investable project. Your payback still sits at just over 4 years. The IRR is around 21%. The net present value does drop because you see that rising rates later in the life cycle of this. We're running this on a 25-year time, and towards the back end, the exponential growth slows down, and the NPV ends up being about 1.2 million instead of the 1.8 that we were looking at before. Still a highly investable project.
That's super interesting, Calvin, because one of the things that I find often, especially with first-time buyers of these energy systems, especially those that have maybe self-sourced a couple bids, is they look at them and say, man, why are these wildly different? And it could be as simple as one of the suppliers has made a utility price escalation assumption of 2% and another of 8%. And that could, in the example that you shared, or 2 and 10, you've got a 1.2 million NPV and a 3.6 million NPV. It's wildly different, and it could be just one single assumption like that. So
yeah, absolutely.
I do want to switch. One of the things you touched on as well is around the operations and maintenance of these, and how are companies navigating that? Because there are some firms that are operations and maintenance specific companies, but then oftentimes the folks that are building these systems offer that as a service. And then from a risk perspective, I'd also be curious how we see things like workmanship guarantees work their way into these contracts, because I think if there's issues with the install, that's probably going to rear its ugly head in the first couple of years of the project. So how do we get around some of that?
Well, the first thing to be aware of with these kinds of assets, there's not a lot of moving parts here. So actually the O&M burden of a solar and battery project is substantially less than many of the other types of capital investment that a company might make. I used the example of a big rig earlier on. There's a lot of maintenance that goes into one of those. Really what we're doing here is making sure that, debris is not gathering, or that things that are left outdoors in the sun are not degrading. That's primarily what the maintenance element of this is. And of course, there will be maintenance issues. If you leave anything out in the sun for 30 years, things will eventually go wrong with it. But O&M costs are low. If you think about it just on a total life cycle cost perspective, the number to have in the back of your mind is that roughly 10% of the life cycle costs of the system are operations and maintenance, and roughly 90% is in the upfront cost of the install. If you do system augmentation, if you repower a battery partway through the life of the system, it can be a little bit more than that. But generally speaking, the importance of O&M is about getting the performance that you want from the system and that you've modeled from it, much more than it is about driving the cost of the system. So what goes into O&M? There's monitoring, which is really important, making sure that you're keeping an eye on production, and then fault response, both remote and then in person. Obviously, rolling a truck to a site is far more expensive than being able to reboot an inverter remotely and digitally, but you need the capacity to do both. Being able to do both quickly is important, because every day that your system's not producing, it generates zero value for you, and that can catch up with you really, really quickly. The other part of this that's important for project owners is having rapid access to parts and service. You're not necessarily going to carry all of the spares sitting at the site ready to replace something that breaks. You might rely on a distributor to do that for you. For a utility scale project, that wouldn't be the case. You'd have a shed full of spares to replace things as they fault out. But for these kind of medium to smaller scale projects, that's less viable. So you need to make sure that you can get a spare that's compatible in a reasonable space of time, so that you don't lose too much production when and if something does ultimately go wrong. To give you a sense of the numbers of what that looks like, so we modeled out, well, what would happen if O&M costs doubled on the project? They were twice as much as what you're expecting. That might be a scary number for your CFO when you start thinking about that. But actually, what does it do to your payback? It moves it from 4 years to about 4.2. You lose only less than 1% of your, less than 1% of your internal rate of return. It's still north of 23%. And your NPV on the project drops a little bit from roughly 1.8 to roughly 1.7 million. Still very investable. And realistically, your O&M costs are not going to double outside of annual inflation, CPI-based inflation, which you account for in the model up front. So you should feel very comfortable spending the right amount of money on O&M to make sure you get the performance from the system.
Last thing that I was going to throw in there is, I know we've seen variations from 1 up to 5, maybe higher, in workmanship guarantees.
It's a funny one. We really like to see suppliers who stand behind the quality of the work that they do. So a more extended workmanship warranty is a really strong indicator of that. We do really like to see that. And keep in mind the nature of the assets that we're installing here. There's no moving parts. So if something is going to go wrong with the workmanship, 80% of the time it's going to go wrong in the first year, maybe even more than 80% of the time it's going to go wrong in the first year. And let's say you got a 10-year workmanship warranty. The tricky thing for your operations team, when they go out in year 9 and find that something's gone wrong, it's going to be hard to make the case that it was the workmanship 9 years ago at the install that was what went wrong versus something that's out of control of the installer, or that had happened at your facility in between then and now. They become challenging warranties to claim against the further that you get away from that install date. Rule of thumb, we like to see a 3 to 5 year workmanship guarantee being included in installations.
So it seems like the kind of big takeaway is the O&M costs themselves aren't a major impact on your business case. But you want to make sure that you've considered it and planned for it, because if the system goes down, and we've seen this, haven't we, Calvin, of some of customers coming to us having tried to do this themselves and sourced the solution through a developer that no longer exists. And because they didn't do the right upfront due diligence, now they've got no recourse and they're left with a system not working, but with no one to come out and resolve it. And so that's the biggest risk, isn't it, in terms of the diligence on the O&M side?
Yeah, absolutely. And it's fair to say the companies that are really good at developing these kinds of systems, they don't want to take on somebody else's problem from a poorly designed or a poorly installed system 5 or 10 years ago, from a poor quality company that's already gone out of business. It's hard to get others to come in and provide that level of support. You really need to make sure that the folks who build the system for you are going to be around to do the operations and maintenance, or to centralize to a national strategy of O&M. You might outsource all of that to one consistent provider. And there are companies out there who specialize in that kind of service to make sure that you get the performance that you're expecting across your full portfolio and that you're well looked after.
So it's been super interesting to see how you think about the risks and opportunities just generally. But I think what's front of mind for most people right now is the tax credits and the foreign entity concern, and making sure that we're considering these aspects in terms of timing and scoping. Can you talk through what's going on in the market right now and what people should be thinking about?
Yeah, for sure. I mean, these are incredibly material in the business case of getting an asset like this constructed. The investment tax credit is going to be 30+% against the value that you spend on the cost. So you can offset 30 or more % of the cost of building the system. And with O&M being such a small part of the total life cycle cost, constraining that upfront cost and getting some of the money back is super important. So I'll jump into safe harbor and foreign entity of concern compliance in a second, but let me just set the stage with saying what happens if you miss out. If you miss out on that 30%, let's just say it's 30% for this example here, incentive, you end up pushing your payback up from 4 years to close to 6 years. It's a 45% increase. Your internal rate of return is dropping down to under 19%, it's around 18.8%, and you lose about 23% of the NPV. And really terminal issues for investability in a project. It's of the risk assessment we did for this project, it's the most impactful thing that can go wrong is that you don't get the ITC, or you'll hear about this referred to in financial literature as recapture risk. You claim the ITC, you might even get the ITC, and then you might be audited later and required to pay it back. The way that this tax credit works, it's an opt-in tax incentive. So when you file your taxes, you have the option to say, I want to claim this. You put your claim in, and then you get the return at that point. So making sure that when you opt in, you're successful and that you don't lose it later. Super, super important.
And what are your thoughts on the most common reasons why you'd fail to capture the ITC?
You have to own the projects for long enough to monetize them. That's really important. And then the thing that's that's a relatively well understood risk for folks who are buying and owning the system for themselves on an asset that they own and control, relatively insignificant. For folks who are involved in investing in portfolios of these assets, getting good advice on how that works is really, really important. Anyone who's in the tax equity business, this will be very top of mind. The other that's become a really substantive issue in recent times is FEOC compliance is generally what it's referred to. It's foreign entity of concern compliance. To claim the ITC, the start of this is that you can't be a foreign entity of concern. So that means you can't be associated with or funded by by foreign entities that the United States government are unhappy with. Primarily, the concern here is China, though there are a couple of other countries on the list. But beyond that, the equipment that you source for your projects also has to be sourced from not a prohibited foreign entity. So you can have a certain allowable portion of equipment from prohibited foreign entities. And as long as you don't exceed the threshold, you're reasonably comfortable. The general rule of thumb for C&I projects is you need to have, of the three big cost components, so that's the panels, the racking, and the inverters, 2 out of 3 of them need to be compliantly sourced, so not sourced from a prohibited foreign entity. I can dive a little bit into like how does that work in practice, and what are some of the impacts that are being driven in the market, if that's a useful place to go.
Yeah, I think it's a question that's top of mind, especially as folks, we're pushing towards the end of the year here. We're recording this kind of near the end of October, and folks that aren't going to be able to get their projects safe harbored before the end of the year, they're going to be subject to FEOC compliance. So what does that look like in practice?
Yeah, perfect. So the OEMs, the equipment manufacturers, are going to be the folks that you end up leaning on here to demonstrate compliance. And they will share documentation with you that shows that they're not a prohibited foreign entity, and that their materials are compliant with the FEOC rules. Typically, they'll only do that under a non-disclosure agreement, because it does require them to reveal some details about their supply chains that they may not necessarily want to be public knowledge. And they won't do it unless you ask. So you need to make sure that you do ask for that detail. Project funders, so typically these are power purchase agreement funders. They're actually quite used to this. Under the Inflation Reduction Act, there's a section there for investment tax credits where you can claim a domestic content bonus for equipment that's manufactured within the United States. And this is not exactly the opposite to that, but it is in some ways the opposite to that. Domestic content bonus, the way that folks got comfortable that projects that they were investing in did qualify, was typically a letter from some trusted third party. Think a reputable tax advisor or somebody like a Deloitte that had come in and issue a statement that the project does comply with the legal requirements for domestic content. They will end up doing the same thing for prohibited foreign entities and foreign entity of concern compliance. And there'll be a letter required. It'll cost some nominal amount of money to get people to come and do the assessment, but you'll need to have one of those for your project to be backable by institutional capital. The big lesson to me in the market at the moment is this is a real opportunity in the supply market for suppliers to have their ducks in a row. We do see more kind of hand wavy, this will be okay, you've just got a safe harbor, after that it'll all work itself out, then I think is a good thing for people who are investing, particularly companies who are investing in their own infrastructure here. Suppliers are not the ones necessarily bearing the risk of recapture or of non-compliance. So they just sort of say, don't worry, it'll be fine. And the ones that have really got their ducks in a row and say, no, this is exactly how we will deliver to you all of the compliance actions that are required, plus the traceability that's required in a consistent set of documentation that you can rely on and you can reference, if you're ever audited at some point in the future. That's actively winning the suppliers who are well-organized business. We're seeing that quite consistently, that there's a marked difference between the companies who have really got it nailed down how they're approaching it versus the ones who are sort of saying, look, we've done this for a long time. It'll work out and everything will be fine.
And I think within that, and this is certainly an area where we can help as the project gets built, you're going to get a closeout package. Like on a CapEx project, you're going to get a closeout package, and that should contain all the documentation. And I think it's really important for buyers of these systems to review that prior to like parting ways with their installer to make sure that 8 years down the road they don't get a surprise and say, oh, well, there's a missing document here. So like what does that look like?
Yeah, absolutely. Really, for people who are not doing a lot of these projects, you need someone to rely on who's going to help to shape for you, are the right pieces of documentation here, and do they say the things that you need them to say? The two places to go for that, without patting ourselves on the back or folks like VECKTA, is to work with somebody who's in the market all the time and understands what's required. And the other is suppliers should know about this really well, and you can ask them to share their knowledge too.
Kevin, I think one thing that I hear a lot too is concerns around price of equipment, particularly that equipment that complies with foreign entity of concern or doesn't have too much of the ratio from a prohibited foreign entity. Prices just skyrocketing. But we saw in a recent project where they had the option on the table that did comply with domestic content, and the buyer posed the question to say, well, can I get a discount if we don't use domestic content? How did that end up playing out?
That was a really interesting example. It's one of the first we've seen where a buyer had asked, what if I don't have domestic content? Can I get a discount to use foreign source material? And this particular supplier came back and said, look, we'll look into it. Went away and did the work and came back and said, no, we'll give you, like, the price will remain the same for domestically sourced equipment versus offshore sourced equipment. That supplier does a lot of bulk buying. They're a relatively large installer and developer, and they've got great pricing negotiated for their domestically sourced equipment. So it's starting to get close to cost parity. We haven't seen a lot of that until quite recent times. The other thing, like, to answer the earlier part of your question there, Dan, what's going to happen post safe harboring deadline at the end of 2025 to the cost of equipment that is FEOC compliant through 2026? The short answer is no one really knows yet. The market will land where it lands, though we do expect equipment costs to go up. Not dramatically. We're not expecting too many projects to completely lose investability as a result, but prices will go up. And equipment is the most substantial part of the cost structure of getting a project constructed and deployed. So it can be quite material. Go back to if the cost of equipment goes up by 10%, what happens to the investability of your project? Those numbers again from an earlier example. You add from 4 years, your payback goes up to about 4.4. You lose about 2% on your internal rate of return, and the NPV of a $1.8 million return project drops to about $1.7 million. It's not going to entirely tank the project, but it does reduce its attractiveness, and for you as the buyer, adds a lot of compliance burden to make sure that you do your due diligence on all of the equipment that's being installed, to make sure that you don't lose the ITC later. And that really is the place where there's a sting in the tail.
What is the impact of that, Calvin, if you get the ITC wrong or you screw up your FEOC compliance?
Well, if you lose the ITC, it can be really terminal for a project. So you'll see paybacks increase in the order of 45%. Internal rate of return, we saw on this project drop from around 24 to around 19, and the NPV dropped by 23% was the example here, but very substantial to miss out on the ITC. Much worse than seeing a 10% increase in the capital cost of the project.
Calvin, one other thing that we've seen a couple times, and I'm curious what what buyers can do to protect themselves. But just, and I imagine this is only going to amplify as more folks are looking to safe harbor projects and get projects placed into service by 2027. But installers, EPCs, developers overcommitting or just having a very large queue of projects that need to be built, and your project maybe getting deprioritized or slipping down in the queue, and therefore it's going to get built later. You're going to continue to pay your high utility costs, for longer. What are some ways to protect against that, and how can you, if you are subject to that, recoup some of those lost value streams?
Yeah, absolutely. Time is money, and we're none of us are here to sit around and not take action. The reason that we work on these projects is to get them built and get them generating energy and generating value. So delays can be really costly to the overall economics of your project, and just an incredible source of frustration for your teams who are expecting these things to be done. It's all just work that adds on. So the other thing that's important, if you contract somebody to come and design and install a project like this for you, is they're in control of a lot of the timeline. They know how long it takes to order long lead time equipment. They know how long it takes to construct the project. They know how long it takes to commission the project once it's built. And there are a few things that are outside of their control. You mentioned interconnection. Permitting is a big one as well. Making sure that when permits are filed, they're actually approved and that you get permission to build and operate the system as planned in a reasonable space of time. Utilities can be a law unto themselves a little bit here. They are monopoly suppliers, and to their credit, they're also required to make sure that any changes to the electrical distribution network don't negatively impact anyone else who's using the network with instability or shutdown. So there's some hardcore electrical engineering that goes into the back end of approving these sorts of things too, that we do need to keep top of mind. That being said, what are the approaches here that companies need to be thinking about? When you contract someone, the things that are in their control, they need to do with a sense of urgency. Anything for a project in a commercial and industrial space where there's a longer than 12-month time frame between being approved for construction and mechanical completion is really unacceptable. And generally, the time frame should be substantially shorter than that. And it's reasonable for companies to expect some form of damages for delays that run longer than that. Remember, every month that you delay, that's another month where you're paying ever escalating utility bills, while a developer or a constructor might just be waiting to fit you into their preferred construction schedule now that they've secured the work. That's not a good outcome for you. So make sure that that's there and do it in a way that's flexible. So when delays happen that are outside of the control of the constructor, that they're not being unfairly penalized, or that they're building extra margin into your costs to account for the risk that they might be penalized for things that they don't have any control over.
Yeah, so Calvin, I think this has been really good. I think Dan and I would have struggled to cover even half the ground, so it's been really great to get the inside track from a procurement, contracting, and operational perspective. These projects are amazing when they're designed, planned, contracted, and deployed most efficiently, based on having talked through this, living and breathing it every day, modeling a bunch of these scenarios that you've been talking through. What are the big takeaways that you want to leave everyone with?
First and foremost, make sure that you get the ITC. That's the biggest thing that's going to hurt. And then make sure that you get the production that you're planning, so that you're getting the operations and maintenance support and contractual support that holds that up as well. If you get those right, you're going to be pretty comfortable with the risk profile of these projects. The other thing here is that, of course, with any substantial construction undertaking like this, there are risks to think about, but you're hardly the first person to contemplate doing these kinds of projects, and they're having hugely positive impacts for the leaders in on-site energy deployment today. They're creating, substantial, long-lasting competitive advantage in the market by having these kinds of assets in place. It stabilizes their cost base. It keeps the lights on in an unstable market. It just takes the heat out of all of the kind of tumultuous questions about energy pricing for these kinds of companies. And there are moving waters as it relates to incentives and government policy at the moment that are very navigable, provided you've got the right advice and the right partners in place. So find people that you trust who can help you to work through what the different scenarios are and what they might mean for your business. And then our advice is always get building. If you had the opportunity to go back in time and build a bunch of these sorts of projects in 2020, almost every business in the country would say, great, take me back, let's do it. The best time to do it was a few years ago, but the next best time is right now. So anyone who's worth their salt here should be thinking very hard about what the right strategy is, and then putting pen to paper, signing contracts, and ultimately breaking ground and getting projects built.
Well said, Calvin. This has been super helpful. As any business leader who's been pushing on these projects knows, it's an organizational decision, and mitigating the risks and across a lot of the things that you described will help get those that are kind of maybe cautiously optimistic to give their blessing to get these projects done. So super helpful. And the one constant is the market's going to continue to be dynamic and change, but it doesn't, anything worth doing is not without any risks. It's just how you make sure that you mitigate them and maximize the opportunities. So it's been awesome, Calvin. If anybody has any questions, we can put you directly in touch with Calvin to discuss any of these things in more details.
Yeah, that sounds awesome. This is what we live and breathe. We spend our days de-risking and helping people to feel awesome about the opportunities that they've got in front of them. So happy to talk to anyone out there in the audience that's interested in the space.
Love it.
Good one. Thanks, fellas.
Appreciate it, Calvin. See ya.
Bye.
Hey, Dan, that was really good. I think it was great for Calvin to take some time out and talk us through some of that, because I think this is the biggest risk and opportunity, isn't it? Is that we can't be making low cost based decisions. These are value driven investments. We're investing in an asset that's going to perform for years to come, and it's really important that we're making very smart value driven investments. And I think some of the key takeaways for me was production is the most critical part of a project. If we're not designing the system to meet our desired business objectives and realize the production guarantees that we expect from the system, whether it be solar, batteries, gas turbines, it doesn't matter. It has to produce as we planned. That's super critical. I think production guarantees are available on every project. We need to just make sure that that's specified in the RFP and that suppliers are building that into their solution. I think second was we need to make sure that we have rock solid contracts. I think it's very easy, isn't it, is to go through the process, get to the final stages, and then rush across the finish line instead of actually making sure that we're aware of the nuances associated with these projects, and that we understand that some terms are super standard and they've been proven, used time and time again, while others are have some flexibility, and we need to know where there is a difference and how we can influence that. And then lastly, I'd say for me, it's so vital that we've got real-time, up-to-date intelligence. We can't be making decisions on data that's even 6 months old these days. Tariffs are going up all the time, incentives are changing, and we need to be on top of this, because these are the big levers, as Calvin pointed out, that are going to drive the economics of the systems What about you? Any big takeaways?
Yeah, a couple beyond the ones that you already shared. I think the biggest one is making sure that your supplier or delivery partner is the best that you can possibly have, because this is really when the idea of an on-site energy system goes from theory to physical asset built, and so you need someone that you can support you through that journey, from claiming the tax credits and other incentives to complying with the different regulations and making sure that you're meeting those, to giving you a bulletproof package of closeout package of all this information, so that if something does happen and you do get audited down the road, that you've got all the information, all your ducks in a row. Or let's say you don't have the firm that built the system doing the operations and maintenance, you need to have all of the as-builts for the firms to get up to speed as quickly as possible. Or maybe you decide to switch firms because a company pops up in the future that is very attractive. Like, all of this needs to be in there. And really focus on great delivery. As you said, it's not a race to the bottom. You don't want the cheapest system because of the long lives of these. So you want to make sure that you're focused on the delivery and the partner that is doing it. And one of the things that I think a lot of our customers at VECKTA find value in is that if they engage with a developer directly, and that developer or EPC takes them for a bit of a ride, they might stop working with them, and that installer loses all future work with that particular client. But nobody else in the market's really going to know about that. Well, with VECKTA, the suppliers that are bidding on projects know that they need to deliver, because if they screw things up from a timing, from a cost, from a delivery perspective, they'll lose all the future projects that are coming through the VECKTA platform. So there's a lot more at stake for them than just losing future business with that one potential client. And then I think the last is just to really make sure that the involvement from all parties involved is right sized for the system, and that you have someone to support you along the way. We were recently told by a client that we supported getting a 1.9 megawatt system. When asked like what the value was they found from VECKTA, one of the senior team members said, "You guys are like a golf caddy, especially on a course that we've never played before. So where a golf caddy helps us read the greens and watch out for hazards, that's largely what VECKTA did in this process for us, and it made us that much more confident. And we really do feel like we got a ton more value out of this system than we would have if we had gone at it alone." So I think that was high praise for someone that enjoys golf like myself. So we'll take it, and I think don't let any of these stop you from doing great projects. There's so much out there. Even as projects push across the next couple of years and the ITC goes away, there's still going to be great projects. It's just making sure that you manage the risk and maximize the value.
Love it. Appreciate it.
Take care, guys.
Right, see you. We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition, what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at vecta.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.